Hello, I'm Brian Shaitkin, Senior Economist here at the Conference Board, and welcome to Human Capital Watch for May 2018. On this program, we're going to be covering our 2018 labor market outlook, which is why in this program you will see economists rather than human capital researchers as presenters. You are still in the right place. And what are some of the key questions that we're going to be answering as part of this global labor market outlook? First of all, how tightening labor markets are impacting employers. How companies can offset the effects of a tightening labor market by delaying retirements, expanding non-traditional work arrangements, and lowering educational requirements for job openings. How holding back on compensation growth could impact employee turnover, recruiting, and job satisfaction. To earn credits for CPE, HRCI, and SHRM, simply follow the directions under each of those credit types. You'll have to stay online for the entire hour, and credit availability will only be granted for live participation in the webcast. Just click OK as pop-ups are delivered throughout the webcast. You will notice there are no special directions on a slide for how to participate. That's because you'll see participation directions interspersed on the screen. And we thank our webcast team for developing that new method of describing participation. But I would urge all of you to ask questions throughout the webcast because it does create for a more interactive format and allows you to learn those most important aspects of our labor market outlook. So joining me today, first of all, is senior economist Elizabeth Crowfoot. She is going to be talking about both our international labor market comparison program along with the labor market handbook, institution's handbook, which is an incredibly valuable resource that we'll learn more about later in this program. Elizabeth, thank you for joining us.
Thanks, Brian. Good to
be here. And also joining me to my right, normally we're arrayed in the opposite direction, but Gad Lebanon is the Chief Economist North America from the Conference Board. He is the lead author of the 2018 Labor Market Outlook. And Gad, we look forward to hearing your insights about what to expect from U.S. and global labor markets during this year.
Thanks, Brian. Happy to be here.
Thank you. So first, just to set the scene, what does the global economy and the U.S. economic picture look like right now? The key word is synchronized expansion. You have the U.S., the Euro area, and emerging markets doing quite well and growing at quite a strong pace right now. But there are downside risks that are present in 2018 that weren't necessarily present in 2017. Those start in the Euro area, where we are seeing growing signs of weakness, a bit of a slowdown as the labor market tightens, as supply constraints become more of a factor. The economy could slow. It should still grow at a perfectly healthy pace during 2018, but may not be able to maintain its current pace of around 2.5%. Emerging markets are largely supported by domestic factors right now, consumption and investment, but we're not anticipating any further acceleration from mostly good numbers. Global trade growth has been picking up and did recover during 2017. There are mounting concerns about how trade policy is evolving, how key relationships among NAFTA zone countries, the U.S.-China trade relationship, and the U.S.-EU trade relationship are evolving, and that could cause businesses to pause from investing more simply because of fears of supply chain disruptions and things like that. And importantly for our webcast, productivity growth has improved in mature economies, especially in Europe, that's supporting the recovery. And global labor markets, they are tightening. We're seeing unemployment rates falling. We're seeing some upward wage pressure developing. And as a result, talent is becoming more difficult to find across many, many economies, and we'll get into how that's playing out in the US, in Europe, and from a global perspective as well. What this chart shows is our leading economic indexes for the Euro area, China, India, and Brazil. I do want to draw your attention to the blue line, which is the 6-month growth rate in the Euro area leading economic index. And you could see that after picking up throughout 2017, that growth rate has been stalling in 2018. And what that means is that not necessarily that the Euro area will begin growing much slower than it is now, but it could slow down somewhat. And so that is a critical market for both US and Chinese producers. And so we would expect there to be less external support to US economic growth and also to emerging market economic growth as well. Turning to the US picture, business and consumer confidence data still show high confidence among both groups, which leads us to believe that strong near 3% growth will prevail through the end of 2019. But again, risks are rising and spreading across more areas. So consumer spending should pick up after a modestly disappointing Q1, given how strong the labor market is, that employees have money to spend, and also due to fiscal measures, including the individual tax cuts, which will provide consumers with more to spend. In addition to that, tightening labor markets could also lead to faster wage growth, but that also could mean rising inflation risk. And as a result of that, the Federal Reserve may have to increase interest rates. That can drive capital costs higher for firms and home buyers, so that can provide a headwind in the way of growth. Uncertainty around trade policy, again, could affect firm investment behavior. In addition, we have seen some turmoil related to technology stocks. For right now, it appears that those key technology companies, their equity market valuations have recovered, but they are certainly operating in an uncertain environment. And firms across the US economy, not just those in technology stocks, are sort of deciding whether to make those key digital investments, what the composition of those should be, and whether they should wait a few months to see how some of this turmoil plays out. And finally, economic conditions, economic accelerations globally have cooled, which may again reduce support for US economic growth in the rest of 2018. So finally, in terms of an economic update, we come to this chart, which shows our GDP projection is running at around 3%. Consumer confidence numbers, you can see in the red line, continue to be as high as they've been since actually 2000, which is beyond the scope of this chart. But that shows just how strong consumer confidence is given labor market conditions. And in addition, that green line business confidence is also at a very high level. So all in all, as long as those two confidence indicators stay strong, we expect the US economy and by extension the US labor market to stay strong. But one of the factors that could bring this expansion to a slowdown or possibly a halt are labor market conditions, the availability of workers, and the availability of talent. Gad, what should we be looking for in 2018 and beyond?
Yeah, no, that's a good question, Brian. I think that the main message that you're giving is that the economy is growing quite rapidly, both the US and the global economy. It's been growing for a while, but in 2017 and 2018, it's even accelerated, and confidence is at a very high level. And that's coming at the same time when there is a very important underlying trend, a demographic trend, which is the working age population is barely growing at all, and in some countries, it's even shrinking. So we've seen this trend, and we started talking about it in recent years. And we said that a combination of those things, that solid employment growth and almost no growth in the supply side of the labor market because of the retirement of the baby boomers, would lead to a tightening labor market. And now in May 2018, we're at a point where many parts of the world and the US are experiencing a tight labor market, which in its essence means that it is becoming increasingly more difficult to recruit and retain qualified workers. But at the same time, while this is the trend globally, there are significant regional differences, both in the US and globally. So there are some areas where labor markets are extremely tight and it's almost impossible to find qualified workers. And there are areas where labor shortages are still years away, if coming at all. So this variation is pretty unusual. There are areas where you have plenty of available workers and areas where you have no available workers. And we think that as this trend continues, employers should focus more and more on those variations and consider them when they make operation and location choices. And this trend will almost certainly continue, because the driving force here is the retirement of the baby boomer, which is certainly will continue for 10, 15 years in most countries. So we probably haven't seen the worst of this labor shortages problem yet. We are seeing signs that it is harder to recruit and retain. Where we don't see the full impact of labor shortages yet is in wages. So there is some acceleration, but it is still not, we're still well below in terms of wage growth compared to pre-recession rates. And part of it is because of other determinants of wage growth, like inflation and productivity, labor productivity growth, are still growing slowly. So even though labor markets are getting tighter, there's still some other factors holding back wage growth. But we are expecting, as the labor market continues to tighten, we are expecting to see further acceleration. And where we do see in the United States already a significant acceleration in wages is in blue-collar and low-skilled services, which is somewhat surprising, because for most of recent decades, white-collar, high-skilled occupations saw faster wage growth. But in the past year or two, in the US, we clearly see faster growth in wages among blue-collar and low-skilled services occupations. And as I said, this is only likely to get worse as we move into a tighter labor market. But one of our main messages is this is not, there is a lot that both companies and governments can do to reduce the negative impact of labor shortages. And that's one of the things that we are going to talk about. And there are various things that companies are doing, and government should be doing more. So we shouldn't give up and just accept the tightening labor market as a destiny. We can do a lot of things to reduce the problem. So we'll talk more about that.
And Gad, you're emphasizing that this is a global problem. And I think this chart shows it well. Elizabeth, can you talk about how demographically induced labor shortages are playing out across different countries around the world?
Yes, I think Gad really touched on the main issue here, that labor shortages are not just a problem in the US, but they are globally as well. And it's this variation in demographic trends that are really impacting the extent to which countries are experiencing labor shortage. And one measure that highlights that risk of labor shortage is what you see on this slide here. It's the ratio of people aged 60 to 64 to those persons aged 15 to 19 in the workforce. And essentially, this is a proxy for the number of people who are about to exit the workforce over the number of young persons that are starting and willing to enter the workforce. So in this particular chart, a value greater than 1 signifies that there's a greater risk to labor shortage in a particular country, and a value lower than 1 signifies a reduced risk or less of a risk. And for some of these countries, we're seeing that, especially in Japan and Eastern Europe and in Germany, they have a very strong risk or high risk of labor shortage because of their growing or their aging population, and they're expecting more exits to the workforce. On the other end of the spectrum, we have countries in Africa, as well as Indonesia, India, and countries in Latin America, where there are many young people in the ranks waiting to enter the labor market, and where labor shortages, where we don't expect them to be a problem in upcoming years. But going back to where we're seeing those labor shortages, I really think it's Eastern Europe where they're experiencing the highest risk of seeing these labor shortages going forward. Eastern Europe in general has seen very strong economic growth. They're emerging economies that have really taken off in terms of their productivity growth, and are their trajectory has been growing over time, and that coupled with a weak growth in working age population, and also this phenomenon of brain drain, where there are high-skilled, highly educated young persons who are leaving these economies for their more advanced European neighbors for opportunities in those countries, is really tightening the labor market in Eastern Europe in particular.
Now, by this measure, Elizabeth, the U.S. looks like it's in relatively good shape compared with other global economies. There are more younger people entering than leaving the labor force based on this ratio. Does that mean that U.S. companies should not be concerned about labor shortages in the U.S.?
Well, the simple answer is no. There are still a lot of challenges, and we hear about employers saying that they're having difficulty filling positions and finding the right qualified workers, and that businesses still need to be very aware about and make sure that they're acting towards filling these labor shortages going forward.
Absolutely. And what this next chart shows is that many of the Eastern European economies that you spoke about during the last slide have also seen a dramatic decline in unemployment rates in recent years. Is that solely a good phenomenon for those Eastern European economies, or could that indicate some risk to their future growth patterns as well?
Well, there is definitely a risk. I mean, this is essentially what we're seeing here is a proxy for the level of labor market tightness. So we have the difference here between the 2017 unemployment rate and the average unemployment rate between the 2005 and 2007 period, which was a period of relatively normal conditions in the labor markets. And those strong negative values for those countries that you mentioned, Brian, signify that these are countries that have had strong recovery since the crisis, especially for those European economies since the Euro crisis in 2010, 2011. And they are seeing those labor shortages even more impacting the labor market there. And so there is a risk that businesses aren't going to be able to find the workers that they need. On the other side of the spectrum, there are countries, again, largely in Europe, Greece, Spain, and Italy, where those unemployment rates are still very elevated relative to the previous period, before the recession. And those are labor markets that are very loose, and we don't foresee them having any labor market shortages in the future, or anytime soon anyway.
And Gad, for the U.S., we have several measures to evaluate this same question that we do from a global perspective, which is how tight is the labor market now compared with previous recessions? Does the fact that the unemployment rate just went below 4% for the first time in a generation mean that the labor market is as tight as anything we've seen in recent history?
No, so we don't think that it's quite as tight as the unemployment rate suggests. And what we have here in this slide, the red line is the unemployment rate. And you see that in April, it went below 4%. It's at 3.9% now. which is already below the 2007 rate, which was right before the recession. And it's at about the same level that we had in the year 2000, which was the tightest labor market we experienced since at least the 1960s. But while the unemployment rate is extremely low, there are other groups in the population that are likely to join the labor market if the labor market is tight enough, which are not actively looking for a job and therefore are not counted as unemployed. The Federal Reserve of Richmond, they created a measure that takes those population into account. So, you know, if if you say that you want a job, but you're not actively looking for one, you still potentially could join the labor market. If you are, even if you say that you don't want a job, it turns out that you are very likely to join the labor market anyhow. So, so those groups are still are not indicating that the labor market is as tight as the unemployment rate. And the blue line is this measure by the Federal Reserve Bank of Richmond, and it suggests that we are essentially back to 2007 rates of labor market tightness, not 2000, but still a significant progress has happened in the past 8 years, or even, more than 8 years of constant expansion, to the point that we are in a tight labor market and probably equivalent to the 2007 situation.
So given this current level of labor market tightness, how difficult is it now for firms to find the talent they need to fill particular positions?
Right. So there are various measures of recruiting difficulties, and they're all suggesting that it's pretty hard to find qualified workers right now. The measure I show here in the blue line is the vacancy duration measure, which is essentially how many days it takes to fill a position. And we see that this blue line, which relates to the right axis, is already well above 2007 rates. It takes more days to fill positions on average. And this is partly reflects the labor market tightness, but it's also for other reasons. The main reason, I think, is that when the labor market was very weak in the US right after the Great Recession, companies adjusted their requirements for job openings. So they asked for more experience and especially more education. And they managed to get away with it because everyone needed a job back then. But as the labor market got tighter, companies were kind of reluctant to lower those requirements again. And then it became harder and harder for companies to find qualified workers. We are seeing in the last couple of years signs that companies are forced to relax those requirements. We see more and more people at the lower end of the education scale, people with no high school diploma or just high school diploma, rejoining the labor market and are a bigger part of the hiring pool. So there may be some change in that direction.
But I find this vacancy duration measure to be truly remarkable because it's saying that today it's taking firms 27 and a half days to fill a position compared with around 22 and a half days even in the tightest labor market in memory. Mm-hmm. This despite the fact that since 2000, the amount of tools that employers have to reach employees through digital platforms has grown exponentially. Why is it that it's actually taking firms longer to fill positions rather than less time, considering that they can reach so many more candidates than they could in the past?
Well, the process allows them to reach more candidates, but that also creates more work to sift through the large amount of resumes that you get. So I think the fact that companies are now using tools that they couldn't use before probably improves the hiring process, but doesn't necessarily shorten it.
Right, and that then takes us to
But if, Brian, if you can stay on this slide for one, because the red line here is also very important. That's the quits rate. So it's not only harder to find qualified workers, it's also harder to retain them, we see here. So the red line is the percent of workers who voluntarily quit their jobs, mostly to go to another job. And we've seen a significant increase in that measure to the point that we are now back to 2007 rates or even higher. So it is, people are more likely to quit their jobs now as they were in 2007. The red line is essentially a mirror image of the unemployment rate. So as the unemployment rate continues to go down, we expect more and more people to quit their jobs. So that's probably equally important impact on companies as just the difficulty of recruiting.
And just to clarify, the blue line captures the average length that takes a company across the entire economy to fill a position.
Yeah, so I wouldn't take the number so seriously because it's an average of McDonald's workers and the medical doctors, which obviously have very different recruiting periods. So the number of 27 and a half days is not meaningful, but what's meaningful here is the trend and that it is already well above 2007 rates.
Right. And I mean, a key thing in understanding that's taking firms longer to fill positions and more employees are quitting is that it's leading employers to have more difficulty recruiting the types of workers that they want. What do we know about how concerned employers are about the type of workers they have access to hiring?
Right. So in that measure here, this is a survey by the National Federation of Independent Business, and they ask every month what is the most important problem you face, and they have various options: taxes, inflation, sales. They have over, I think, 10 options, and one of the options is quality of labor. And we see that in this chart that at around 2009, 2010, right after the Great Recession, less than 4% of companies viewed labor quality as their biggest concern. At that point, they had other concerns. But now with the tightening labor market, now at 22%, quality of labor is the number one concern of companies. It's about back to 2011. So yeah, it is harder to recruit because there isn't the quality of the workers that are available now in the market is lower than it used to be.
So given the fact that employers are having more difficulty finding the quality of workers that they may want, one way of attracting those workers would be to pay more for them. Yeah. Is that happening right now?
You know, companies don't like, in general, to raise compensation because that directly leads to lower profits. So it's usually not the first tool that they use. So we are seeing that lagging a little. But if you see, those are the two most popular measures of wage growth. One is the blue line is the average hourly earnings. The red line is the employment cost index. We see kind of over the last, during the last expansion, an acceleration in those measures, but the acceleration has been mild, and we are still, after 9 years of expansion, we are still below 2007 rates. So the answer is that the wages have been accelerating, but they are still not where one would expect them to be. As I mentioned earlier, partly that could be a result of inflation and labor productivity, which are important determinants of wage growth. They are still weak, but it could be also other factors that, there could be the labor markets in kind of fundamental ways different than it was a decade ago in terms of the impact of globalization, the impact of non-compete agreements between companies and other, the weakness of unions. There may be other factors that are contributing to the lower wage growth.
So this red line here, the employer cost index, captures what changes in wages are if we assume that the composition of employment by industry were to remain constant. And you did some work where you looked specifically at certain groups of industries to see how trends in wage growth are evolving. Where do we see more and less acceleration, and why?
Yeah. So one of the good things about the employment cost index that I would say two things. It takes into account the compositional changes among employees, but it also provides data by occupations, which is very important. And what we see here, I divided all workers into two main groups, which I called white collar versus blue collar. So just to give you a sense, so white collar are management position, finance, business, professional, sales, and office administration. Those goes into white collar. What goes into blue collar, which is in the blue line here, of course, is things like construction, extraction, transportation, warehousing, and low-skilled services like food services and what other a group of
janitorial services.
Yeah, janitorial, kind of the low-skilled installment and maintenance kind of occupations. That falls into the blue collar. And what we see here are two very different trajectories. One, the blue collar occupation, there has been a significant acceleration in recent years to the point that we're almost back to 2007 wage growth rates. Whereas in the white collar occupations, we've seen a much milder acceleration, and we're still almost a percentage point lower than we were in 2007 rates. So that's a very different scenario, a very different reality. And it's not, it's in somewhat surprising because historically the green line has been growing faster than the blue line in most of the recent decades. But one thing that we learned from our work on labor shortages is that it's not surprising that some of the blue collar occupations are suffering from shortages faster. Many of those, they have very high retirement rates, a lot of older workers. And many of those jobs are not the cool and sexy jobs that the young generation wants to get into. So there are a lot of retirements on one hand and relatively few new entrants on the other. And that is creating shortages and faster wage growth.
Absolutely. And Gad, I think you've laid out the problems our members face, not just in the US, but globally. A set of labor markets where talent is harder to come by, where that deficit in talent exists across occupations at all skill levels. Mm-hmm. So given that these trends are unlikely to change anytime soon, what can our members do about it? And also, on this chart, we can see that these trends are likely to remain with us for some time. So first of all, take us through why is it that these trends are unlikely to change soon and labor shortages are likely to be a long-term rather than a short-term phenomenon?
Right. So if you're not scared enough yet by the risk of labor shortages, I think this chart should scare you even more, because what that chart shows is in the United States. And again, if you remember, in some countries, if we put a chart like this, it would look much worse. But what we see here is the blue line. This is the annual percent change in the working age population, here defined as 18 to 64. We see that this number used to be, if you go all the way to the left in the blue line, we see in 2000 it was 1.3%. Earlier, there were periods that was even 2%, but it's been shrinking. This number has been going down to the point that we're now at 0.3, and later in the decade it will go down to 0.2% growth. So essentially, almost no growth in the working age population for the next 10, 15 years. And by the way, this is a projection by the US Census. But what we did here is we decomposed this blue line into its three main contributions. So you have the green line is what the census assumes will be the contribution of net immigration. The brown line at the bottom is the negative contribution of deaths. But the most important line here is the red line, which what we call the 17 to 64 contribution. So every year, the 17-year-olds are entering the 18 to 64 group. And every year, the 64-year-olds are exiting this group. So how fast this group or how fast the blue line will grow depends on how many 17-year-olds there are compared to 64-year-olds. In the year 2000, there were 2 million more 17-year-olds versus 64-year-olds. Now it's almost zero, and in the next decade, it will be literally zero. The baby boomer generation is so large that it is as large as Generation Z, which is the generation that is going to enter the labor force in the next 10 to 15 years. So, and this is almost a done deal. Like there is very little that could change the blue line in the next 10, 15 years. All the people who will join, the Americans who will join this group in the next 18 years were already born, so we know exactly how many there will be. The only thing that could significantly change this blue line is the green line. If we let more immigrants in, the blue line will go higher, but if anything, the recent political developments, that means probably the green line will go lower rather than higher. So this blue line is essentially, there's very little that could be done about that, and we would need to find ways to increase our pool of available labor through other means.
So the red line is showing us that there will be nearly zero labor force growth between around 2018, so around now, and around 2030. And based on some of the earlier charts that we saw, this picture is even worse in some of the other countries that our members are operating in. So what steps can firms take to deal with labor shortages over the next 10 years, because they're going to be with us throughout that time?
Yeah, so it's not an easy problem to solve, but there are things that could be done. So I think, first of all, they could increase labor force. Labor force participation in many countries still has room to grow, and in particular, female participation rates is on the rise in many parts of the world, and older workers are staying longer in the labor market. So those are simply increasing the labor supply by increasing labor force participation. Another way is to raise compensation to draw more people into the labor market, and companies are starting to do that, and I think more and more will have to do it, because companies who will hold back on raising compensation will lose more and more in the war for talent and will face higher labor turnover. Another way is to, as we talked about before, relaxing some of those qualifications for job openings, allowing people with lower education and experience enter your company. That could also increase the labor pool that you're dealing with. A good solution in the jobs that where it's possible is to increase automation, and by that reducing the demand for labor. That is happening, although during the past expansion we've seen a significant slowdown in the rate of labor productivity growth, which is somewhat surprising given all we hear about innovation and technological progress. But we think that in a period of tight labor market, when the labor cost issues are growing, companies will be under larger pressure to automate and reduce labor demand. We're also allowing more flexible working arrangement like teleworking or working from home that's another way to increase the labor supply, and we are seeing a significant trend in that. And finally, using more contingent workers, people who work only when you need them, that is likely to, the demand for that is likely to increase for those types of workers. But at the same time, a lot of those workers who were forced to work in a contingent capacity may now find a permanent full-time jobs more easily, and that will reduce the supply of those workers who are willing to work in a contingent capacity.
So Gad, you mentioned that one of the key ways in which firms can address labor shortages is by increasing participation in general. And this chart asks the question, among 25 to 54-year-olds, who is participating? And Elizabeth, one key way that labor force participation has been growing has been among women. Why do we see different trends in recent years among the EU countries, Japan, and the US?
Well, it's definitely the case that in the U.S., the labor force participation rate for women especially was historically high in earlier years. And we've seen that the EU and Japan have overtaken the U.S. in terms of the female labor force participation rate. And in the EU, we're seeing really the influence of policies that are more accommodating to women that want to return to the labor force. And in Japan, it's more of a cultural shift where, they're realizing that they, with limits or reduced immigration in Japan and an aging workforce, that they need to leverage other segments of their population, and women is, one of those that they can really tap into in Japan. And you've seen that the EU and Japan, they're really seeing accelerating levels of female participation.
And that's critical because among men 25 to 54, we haven't seen improvement in recent years.
No, and especially in the U.S., you see that decline in male participation is much faster than in Japan and the EU. And in the U.S., especially since the recession, that really impacted the manufacturing sector especially. We see that, which is a male-dominated sector, those workers, lost their jobs, and they have stayed out of the labor force ever since. So that may be one explanation as to why we're seeing even further declines in the U.S. Male participation rate.
And as individuals are living longer across the industrialized world, one possible solution to labor shortages is increasing participation among older workers. What can we see recently in trends in older worker participation? Why is that differing so much between European countries and the U.S.?
Mm-hmm. I think exactly what you touched on about life expectancy, especially in Japan, which has one of the highest life expectancies across many of the developed nations. They recently have instituted some policies to encourage older workers to stay in the labor force for longer because they, like I mentioned, are having that, their workforce is declining, so they need to counteract those labor shortages through other segments of the population, and in this case, the older workers. And in Germany and the EU, it's a similar story where there are policies that have been put in place to really influence it and attract older workers back into the labor market and to stay longer. In the U.S., there has been some increases in older worker participation, but definitely not to the extent that we're seeing in some other countries.
And a critical thing that employers can think about is, given the importance of labor market institutions in shaping trends like what we see here in terms of increased older worker participation among EU and German workers, what tools do we have for our members to compare key features of labor market institutions across countries?
Well, we've recently launched a new tool called the Labor Market Institution Handbook. And I think when we're talking about labor market tightness and the unique demographic situations of different countries, it really speaks to the need for businesses to be aware of the labor markets in different countries, especially if they're operating in those countries or they're thinking about um, operating in those countries in the future. And what the Labor Market Handbook is a compilation of links to both qualitative and quantitative country data about the labor markets. So it includes information on the institutional features and policies that are relevant to conducting day-to-day business in those countries. And some examples, for example, are employment protection laws, wage setting and bargaining, and worker benefits and compensation and taxes and Social Security. Some of those that I just named you can see in a snapshot of the database that's on the slide right now. And we also include information on economic and demographic data trends, not only on employment rates and labor force participation rates, but information about what the pool of workers looks like in those countries by age, by sex, by educational attainment, and other characteristics that employers need to know when they're considering operating in different labor markets across the world. So this tool covers 63 different countries across the Americas, Europe, Asia, some countries in Africa as well. And overall, it constitutes 97% of global GDP. So the coverage is quite expansive. And this tool is really designed to allow businesses to assess and compare the different labor market environments when they're making important strategic decisions about where to operate and about where to expand their market in the future. And again, it's a compilation of links, so it tells employers where they can find the information that they need.
And it's not just qualitative data that the Conference Board offers, it's also quantitative data and comparisons between wage trends in different countries' labor markets. What can we learn from some of the international labor comparisons data about how labor costs are evolving across markets, and how can our members leverage that information in order to make location choice decisions?
Well, the conversation that we've been having about labor market tightness, like Gad had mentioned, impacts trends in wages and productivity. And this is one example that we see here where what we're looking at is data on hourly compensation costs in the manufacturing sector. The countries are ranked by their 2016 level in the orange bars, and they're compared against the 2007 level. And what we're really seeing is sort of the change, the acceleration in labor costs over time between now and the earlier period. And you see that the U.S. is highlighted, and the labor market tightening, we can see that acceleration in compensation is being borne out here, especially in among manufacturing workers, which constitutes, or they're part of those blue-collar workers that Gad had mentioned earlier. We're seeing that in the data here as well and for the manufacturing sector. Other countries that are experiencing increases in labor costs, we see Slovakia here is also highlighted. That's another Eastern European country, and next to that is Estonia, where we're seeing increases in labor cost. As well as in China at the bottom end of the spectrum, which has seen almost a 20% increase in labor costs due to some pressures and labor shortages there, and also just the magnitude of the acceleration of economic activity, especially in manufacturing, has really driven wages up in that country. On the other side, we have some economies that are experiencing either subdued increases in labor costs or actually declines. Germany is highlighted here, even though we've talked a little bit about how they're also experiencing some labor shortage pressure. In this case, it's also a policy story where the German government is holding back labor costs in order to maintain competitiveness through policies in their labor market.
No, and absolutely. I mean, that's a critical factor, sort of thinking about what are the policies that are driving these changes in wages across countries. But the question then becomes, given that labor costs are rising in many mature economies, are employers getting more for their money? What does this chart tell us about recent productivity trends?
Well, the rising labor costs that we just looked at definitely puts pressure on firms to increase productivity in order to remain profitable and competitive. And what we're seeing here is the trend in productivity growth. And starting in even before the Great Recession, amongst mature economies, we saw that productivity started declining. And it's only been recently that we've started to see a pickup in productivity growth over time. Among emerging economies, the slowdown started a little bit later. But again, we're expecting it to pick up in the future, partly because of labor market tightness. There's pressures on labor costs, and it provides motivation for employers to make investments in technology and to automate different processes. So we're seeing those effects in the projections of increased productivity going forward.
And one way, Gad, firms can maybe increase their own productivity is by using continuing education programs and also having staff obtain new certifications. We have a question about that on the line. So what do you think about those two channels in terms of solutions for boosting productivity?
I think it's definitely an important channel. When you have a harder time getting talent from the outside, you need to create it inside, and there is definitely will be a need for that. Unfortunately, training is one of the topics in labor markets that is measured, or that is essentially almost not measured at all. So we don't really have information on that. If anything, I would say in recent years the trend has been for lower training because people take the training and go elsewhere. But I think there will be very few other solutions, so we will see training increase.
And one other solution that we've seen become increasingly important is the idea of teleworking and having employees who aren't located within shouting distance of your office or key production locations. What are the opportunities that firms have to address shortages through teleworking, and in what types of roles can teleworking be a more or less effective solution?
Right. So on that chart, what we see here is the share of full-time employees that are working primarily from home. So I'm not talking here about part-timers or self-employed people. Those are employees who work primarily from home. And we've seen a very significant and continuous increase in that share, to the point that in 2016, 3.1% of full-time employees were working primarily from home. Now, that doesn't sound like a huge number, but remember that this is across all types of jobs, including things like kindergarten teachers, who hopefully will never work from home primarily. And in certain types of jobs, like computer-related occupations, already about 10% of all full-time employees work primarily from home. And we see that perhaps if you look at the last 2 years here, we're perhaps seeing an acceleration in that trend, which would make a lot of sense as people are finding it hard to find qualified workers. They will allow more people to work from home, and that will increase the pool of available workers. So we think that it's likely to continue to accelerate, and especially in high-skilled occupations where the job could be done from home. So we're probably not going to see it among electricians or truck drivers, but computers and other business functions, sales, we may see more and more people working primarily from home.
So you mentioned occupational differences in the role of teleworking, but this chart also shows that there are major variations in terms of how tight labor markets are by state. Could that influence the role that teleworking could play in addressing some of these state-specific labor shortages?
Yeah, so I think there may be areas with a lot of available workers, but companies are not going to relocate to, but they still may use the workers in those areas to as teleworkers. And what you see here, why that is important, is because you see a large variation in labor market conditions across states. So what we have here is, if you remember earlier in the presentation, we showed this measure of labor market tightness. So here we show it by states, and we compare it to the 2005-2007 measure. So each of those states is what's the current measure of labor market tightness versus 2005-2007 rates, which were kind of, for most parts of the country, were years of normal labor market conditions. And we see a large variation in that. So in particular, some of the states that suffered the most from the housing crisis are still have relatively loose labor markets: Nevada, Arizona, Florida. In California, there has been a stronger recovery. And by the way, I should mention that the more blue the state is, the looser the labor market, the more orange it is, or brown, the more tighter the labor market is. Where we are seeing areas that have relatively tight labor markets compared to the recent history are areas in the northeast part of the country and in the Midwest. Those states are suffering from negative demographic trends. People are moving to warmer climates, and they have, but at the same time, they are at least in some of the industrial middle part of the country, they are enjoying from significantly recovering in manufacturing. So the combination of this solid employment growth and negative demographic trends are hurting them and is making them tighter.
So employers have different labor shortages levels that they're experiencing depending on where they're located in the country. But one opportunity that we hear a lot about in terms of addressing labor shortages is through gig economy platforms and different types of alternative and contingent work arrangements. What kinds of trends are we seeing in the growth of those arrangements, and what are some of the key factors that are going to determine future growth trends in those arrangements?
Yeah, if we can move to the next slide. This is indeed a question that we hear a lot from our members, and unfortunately we don't yet have great answers to, because it's a topic that is under measured. What we see in this chart, and I know that we're almost running out of time, but I would say there are some indications that there has been growth in alternative work arrangements like independent contractor, temporary help workers, and workers provided by contract firms. It's unclear how big it is, and certainly the labor market platforms, while it is huge in transportation, Uber, Lyft, etc., we still have a feeling that in other types of industries, they are a very small part of the total. We hear a lot of diverging views about how those labor market platforms, how important role they'll play in the future labor market. But it's something that we are studying, and we'll come up with a report on that in the fall. So we'll have much more to say about that in a few months.
No, absolutely. And some of the key factors that you think are going to drive those trends?
Since we are really running out of time, maybe we should keep that for the report. But the people who have the slides will see some of the main trends that we are going to investigate further.
Fair enough. Just to answer one final question on the line, the reason why Texas's current labor shortage, labor tightness measure is a bit lower than you might expect is because the Texas labor market fluctuates a lot as a result of changes in demand in the oil industry. As oil prices rise, that figure may very well change and be more in line with some of the investment trends that we are seeing in the state. Thank you, Elizabeth and Gad, for joining us on Human Capital Watch this month. Next month, we're going to go back to having human capital researchers on Human Capital Watch, and joining us will be Mary Young, who will be delivering a report about staying above board, legal and ethical uses of employee data. So please tune in on June 20th for that. And please also fill in an evaluation so that we can learn more about your experience on this webcast. Thanks for joining us. And so for Elizabeth Crowfoot and Gad Lebanon, I'm Brian Shakin in New York. Thank you for tuning in.